Hello, and welcome to Bank Nerd Corner, everyone's favorite podcast as we geek out on different banking topics. My name is Alex Johnson, and I am joined, as always, by my partner in crime in this endeavor, the banking and fintech editor at Bank Director, Kiah Hazlitt. Kiah, great to see you.
Yeah. Hey, how are you?
I am doing well. I'm disappointed that I'm going to be on the road this week and next week, and you're not going to be in either of those places. Kiah, what the hell?
Well, I just got back from Japan, and I can really recommend everyone not go to fintech events and actually just go to Japan instead. And so I think I've made the best choice the better choice out of the two of us.
You know, that's fair. That's honestly fair because I'm in Vegas this week for fintech meetup. It's lovely, but it's not Japan. And next week I'm going to CBA Live in Orlando, also lovely and warm, but not Japan. So I can't disagree with you about that, Kiah. Tell us just one super quick observation about Japan that you didn't know before you had gone.
I think we had talked about this once when I brought up one of my favorite crime stories, which was the dime heist. And you mentioned that Japan had a lot of coins.
They do.
And you were right. And so it was so funny to be in Japan and feel like you're in the future. And it's like so clean and like the doors open and the toilets are great. And then to just have so much coinage and that it was like weirdly cash based. And my friend kept being like, why is it so cash based? And I was like, do you think it's the interchange? Do you think this is why Japan is so affordable? Is that they're not paying interchange?
Oh, and you think that they pass that along to the end consumer like they don't do in the U.S.? That's interesting. I like that.
Well, no, because a lot of places were still cash only,
right.
And then and then it was weird to have the like transit card aspect and be like, oh, this is like a super app, and it's interesting about how like the interchangeability of the payment system meant that, I could use my transit app card at the vending machine, but I could also use 180 yen coins,
yes.
So
which you would inevitably
that was
have.
something I was thinking about.
No, it's very true. The one thing I will add to that I observed when I went, my wife grew up in Japan, so I did get the opportunity to go visit her family before they retired. And in addition to the coins, which are outrageously common, and like if you don't have a coin purse, you're screwed, basically. The other thing about Japan is, at least when I was there, they were very like put the money on a tray, all then grab. Like you don't hand people money, and so it was there was a lot of like interesting little formalities. It's always fun. We'll get a more detailed breakdown at some point in the future, Kiah, but I don't want to delay us anymore because we are delighted to have a special guest. Perhaps the most special guest we've ever had on Bank Nerd Corner, which is quite a way to tee this up. But Kiah, would you mind introducing our special guest for today?
Yeah, joining us today is the forming Acting Comptroller of the currency, Mike Hsu. Mike, thanks so much for joining us.
Thank you so much for having me, a longtime listener of the pod.
Well, we are delighted to have you here. I promise we won't spend a lot of time complimenting you or your tenure at the OCC, but I will say one of the things that I think Kiah and I agree on, and we really enjoyed over the last 4 years, was a focus on like first principles thinking and really trying to unpack what's happening in banking. We've talked about a lot of stuff that the OCC did over the last 4 years on the podcast, and there was always a lot of thoughtfulness with which it was done, which we really appreciated and made our jobs a lot easier. So we are delighted to have you here. We're going to pivot a little bit our plan. Normally we cover things that have been happening in the news, but Mike, since we have you, we thought we'd play a little game to start because, again, thinking in terms of first principles, we thought there might be a fun way to attack a bunch of different topics. So Kiah Hazlitt, this was your idea, so introduce our game.
Well, I know Alex loves a game, and
I do.
It felt, to summarize your time as the acting comptroller, I think that, it's a really interesting time in banking, and there's a lot of things that are coming to a head, how banking services are being delivered. And I know banks are dealing with this every single day, but I'm sure regulators are also thinking about this. And I was kind of always struck by trade-offs or what principles are needing to be honored or what's being prioritized and incentivized. And so I had joked that we should play Would You Rather now that you are the former acting comptroller, and allow you to, put you kind of on the spot, but in the nerdiest way possible. And to kind of hear how you think about these, topics that I think are related, and where like you fall down and where we might fall down. So Alex and I came up with some that hopefully are very exciting for you and maybe like a little spicy, a little juicy. So Alex, do you want to start?
I would love to. Yes. So our first would you rather is would you rather banking as a service or fintechs owning bank charters? And just a little bit of context here. On our last episode, Kiah and I talked a little bit about de novo bank formation, which Kiah has been writing about for a long time. I've become more recently interested in. And essentially sort of noting that de novo bank formation essentially fell off a cliff after the Great Recession. And there are very few new baby banks being born. And so when we talk about, and Mike, I know this is a area of intense interest and study for you, when we talk about like the composition of the US banking market and what should it look like and how many banks should we have and what's the appropriate level of banks going away and merging and consolidating versus new banks being created, I think you can't have that conversation without also talking about fintech, because at the same time that we saw a huge dip in de novo bank formation, we also saw the emergence of what I would sort of consider modern fintech and banking as a service, which essentially provided a different way for entrepreneurs to get into market with a bank-like thing without necessarily having to get a bank charter right away. Now, we have seen over the last 10 years some fintech companies, after they've scaled up through that banking as a service model, get to a point where they've tried to pursue a charter, either in a de novo fashion, in the case of Varo Bank, or acquiring an existing charter and sort of refashioning it to fit their purposes. So I guess the thing I'm curious about, Mike, is when you think about those different, essentially paths to market for entrepreneurs who want to start a new bank type thing, what do you think about those trade-offs? How do you approach thinking about that?
So first of all, I love this question. There's so many different paths to go down, but let me see if I can maybe boil this down to two sets of first principles, because it helps to go back to first principles. So the first is that I strongly agree with your premise that it's good to have de novos, but it's good to ask ourselves why. Like, why is that so important, especially in the US? And it's because we have a humongous economy with lots and lots and lots of communities. And I use the word communities in both a geographic sense and in more of a virtual sense. And those communities change a lot, right? They're not static, especially now as you have a digital economy where you've got lots and lots of new things. And so then the question is the banking system keeping up? Are they being served? I think that's a really critical question. And how do you serve them the best? And I think that really comes back to, this is why we need a dynamic, diverse banking system, because we are different than Canada. We are different than the EU. We are different than other countries where we really, really, really need that. So I think it's good to have that as a starting point. And then it gets to, well, how do we get there? And I think this brings this, especially in a dynamic economy, it brings up innovation and competition. Now, Kiah, I like where you started with these trade-offs. I'm going to give you like a framing that comes from central banking, which is like the unholy trinity, which is also used in technology and others. There's three things which are in tension with each other: safety and soundness, innovation and competition, level playing field. So at any given time, usually you can pick two. Right? And at any given time, you, as a policymaker, you try to do all three, because that is what would serve the broadest, the public good, is if you can get all three of those, right? You want safe and sound banking system, you want there to be innovation and competition, and you want there to be a level playing field, but it's hard to achieve all three. And so I think some of these debates that we're having, people will come at it and say, well, we're good on safety and soundness, so let's really focus on innovation and competition and trying to have a level playing field. Or you can imagine other combinations. And for me, what really, really matters is trust. At the end of the day, which environment, like what combination of policies and pursuits will maximize trust given kind of where things are. And I think now where you've got a rapidly changing environment, you really do need to have some emphasis on innovation and competition, but you got to really carefully manage that other part, those other two parts.
Wait, so what's your answer?
Well, you go first.
Well, it's interesting. So I feel like we live in the world where both things are true. Some fintechs got bank charters, and then we have banking as a service. And we actually kind of get to be like, well, what do I wish I had more of? Do I wish I had 5 fewer fintechs that own banks and how that worked out? Or do I wish that there was like banking as a service had a different 7 years? And I don't also want to pretend like every single fintech wants to own a bank. But I feel like from the externally, what I saw was a lot of hesitation from bank regulators to give bank charters to anyone for, I think like really good reasons. But what that meant was that fintechs that they just kind of found like a side door. And I don't know if like we liked how that side door worked for all of the situations. So I don't want to say like every fintech that does BaaS was a good candidate for a bank charter. I do think that the act of applying for a bank charter, hopefully, is like a pretty serious decision. And the decision to become like supervised by a bank is a very serious decision, or bank regulator is a very serious decision. So I kind of wish that there were more fintechs that had obtained bank charters. I just don't know how many more we would have gotten.
It depends a bit on, at the risk of being too nuanced on this, that's great. That's why I love this podcast. There were some attempts where I think you have to unpack it a little bit. There was a period of time where the pursuit of bank charters was one where there was an active negotiation for what I would call bank charter light, right? It was like, hey, we want the charter, but we want special dispensation on a whole variety of things. And, and there were arguments. Look, those are tough calls at the time, because as a policymaker, you're like, do we bring this inside the regulatory perimeter so we can have some visibility into it? But what's the cost of that? Because there were some proposals where like, hey, we can come in, but we want special treatment for the following things. And that can become a slippery slope. I've seen that before, right? Versus, hey, just come in, full service charter, full Monty of regulations, and just go. And at the OCC, we had several of those, right? And so that's one model. It depends on, in some ways, the maturation and whether the are playing the long game or not. And if you're playing the long game, great, let's talk. If it's a short game, I think there's a little bit of caution is probably warranted.
Well, it's a tough line to walk, right? Because I think the other thing that enters into all of this is, to your point about long-term outcomes, like what are you aiming for, right? And I think that one of the biggest misconceptions in fintech over the last 10 years has been there are SaaS company type valuations available in the public market to companies that offer financial services products, right? And this was the whole, we're not a bank, we're a software company, we want to be valued as such. And, it's hard because I don't think that model of valuation is compatible with owning a bank charter. I don't think it's compatible with the relationship you need to have with your prudential regulators. And quite frankly, and Kiah and I talk about this sometimes on the podcast, it's not really compatible with the way that bank stock market analysts value banks versus the way that tech company analysts value tech companies in the public market. They're just not the same, right? And so, you fast forward to today where we have some examples of fintech companies that went public, some of which acquired a charter and some of which didn't. And it's this, I'm utterly fascinated with, like, SoFi is just one example, right? Kiah's gotten into fights, and so have I, with SoFi investment bros on Twitter, where they'll say, you don't understand, like, this isn't just a bank, it's this larger thing. We acquired Galileo, it's the AWS of fintech, all these kind of things. But at the end of the day, like, you are a bank, and that is fundamentally your products. And we have a pretty mature framework for evaluating the value of a bank and understanding the value of its assets. And like, there's a way that we do that. And so I do think that sort of mishmash of expectations creates a lot of potential challenges here. The other thing I wanted to mention, Mike, I'd love to get your take on this as well, is you mentioned like competition and serving communities, right? And I think that one of the interesting hypothetical questions you could ask would be, all right, let's say after the Great Recession, there was a concerted effort to encourage more de novo formation, however you would go about doing that, right? Maybe making the process a little bit easier, maybe revamping certain elements of it. And we get a bunch more de novo community banks that start up in the wake of the Great Recession. Would consumers and small businesses have been better served by that outcome than by fintech companies working with community banks, with banking as a service? Because I think from a competition standpoint and like the way you define community, I think one of the biggest problems with the de novo process historically has been it's a process community bankers go through. And they think about a community a certain way, they think about product a certain way, they think about competition a certain way. And that's maybe not reflective of where the market is now and what consumers and small business owners need. What do you think about that?
That is a great question. I love the way you framed that. And so, again, if I can maybe take this back just a half step, one of the challenges with de novo formation, especially after the 2008 financial crisis, there's a question about risk appetite for failure. That is the central question, right? If we have very low risk appetite for failure, it's going to be very, very hard to bless de novos, because the startup capital requirements and other just conservativeness in terms of the analysis is going to be pretty prohibitive for a lot of folks. And I think what's really instructive is if you look abroad, there are other jurisdictions, comparable in development to the US, that have a lot more de novo formation because their risk appetite is much higher, right? The failure rate for banks in the first 3 years is, in the 20 to 30% range, which would be hard for me to imagine here unless, well, you laugh, but unless there's a broader consensus is that this is healthy for us. And I've had a lot of bilateral conversations with folks who recognize this point, like, leaders on the Hill, other peers were like, yeah, it would be better to get to that place. But we all kind of have to go together, because what that means is that when a bank fails, regulators and the bankers don't get raked over the coals for saying you failed. It's more like, oh, that was part of what we expected. As long as it's not, creating kind of undue harm to communities, that's just part of banking. And I think it's going to take a bit more conversation to get there. But Alex, I think this is important because in your kind of horse race, I think that de novo one would have been better if we had a higher risk appetite for, appropriately so. And that de novo formation was serving communities that otherwise weren't getting served. And then that created competitive pressure on the incumbents to say, hey, these guys are coming in, they're grabbing that market share. We should make a play for that too. That's the healthy, dynamic, competitive spirits that serve communities. And now, have we gotten that through the BaaS, fintech model? Some, yes, on the digital side, but it's been in some select vertical, my sense.
Yeah.
Yeah.
And Alex, Mike, your whole premise about competition, I think, I don't know how you envision the word competition in your head, but for me, I'm thinking like, just because a bank sets up doesn't mean they have like the technology that where like the great financial crisis was a big rift in financial services, but also was a really important time in technology development. And so the question is, what is a new community bank's appetite to invest in the technology that will make it more competitive? Because, the great financial crisis, I think, was maybe one of the where we kind of start seeing the beginning of the end, and it's probably going to be a really long tail of like geographic centric communities and starting to think about communities in a different way. And so, Mike, you mentioned like what BaaS did I think was show basically that the power that technology can do in creating level playing field or creating competition, right? And many community banks feel like that's actually maybe where they're not keeping up, and they are able to, and they're, they use legacy presence as their competitive advantage.
Right. That's exactly right. So I do think now we are very much in a phase, and I'm going to massively generalize, which I criticize others for doing. So
it's okay. You're not the acting comptroller anymore. You can you can make as general of statements as you want.
But I think the window is closing, right? I think there is a window where banks with really strong legacy franchises can ride that for some time, but really need to make those investments, basically modernize and compete on a more competitive base.
Yeah.
Now, entrants can come in and just start off with a competitive base. They don't have technical debt. They don't have legacy, stuff. They can just start afresh. That should be a wedge for them. But if they don't take advantage of that legacy base, that window is going to close really hard at some point. And I worry about that. That's why when I was acting comptroller, I met with lots and lots of community banks, and they would always ask me, what's your number one risk that you're concerned about? And I would say strategic risk. Who is your future client?
Yeah.
And some of the community banks, they actually are very certain about that. They've got a strategy. They don't have to buy every technology solution. They're like, we're going to target those folks, that community. Great. And they're nimble. They're small, right?
Yeah.
Great. But not all of them are there. And I think that's an adjustment that, on the regulatory side, we can try to help. But this is good to have conversations like this that's got to pick up.
Right.
Yeah. No,
Also,
no, go ahead, Kiah.
Oh, I was going to say, this isn't the point of this question, but this question really goes back to, was Durbin a good thing for the banking industry or was it a bad thing for the banking industry? Which I will not make you adjudicate that, but it does, this whole like moment in time that we are talking about kind of does have a direct tie back to a piece of, and then to think about the impact of bank legislation and how do people respond to incentives and how did that shape the world that we are talking about today. Sorry, Alex, I interrupted you.
No, I was just going to put a capper on this one, and then Kiah, we can jump to your first would you rather, but I totally agree with what you said, and I think that one of the things that we also don't maybe talk about enough in this is how effective is BaaS at supporting community banks, right? Because I think another argument you could make about the way that banking as a service works, when it works well, and we have copious evidence of when it doesn't work well as well, but when it works well, like one of the roles that it plays is, hey, we're going to bring in this lifeline of like new revenue or new deposits or new lending opportunities. And if you're smart in the way that you design the rest of your business, you can essentially rebuild your business around banking as a service. And at the same time, with one charter, you can both enable these fintech companies to go serve different communities that don't think in these geographic terms, while at the same time strengthening your role in the community you already serve and are really good at. And so I'm fascinated by the nuances of those different models. And, it's a tricky question to answer. Like, was the last 10 years of BaaS rather than more de novos a net positive or a net negative? Like, if you talk to the folks who still have their money locked up in Synapse, they probably have an answer. But, at the same time, I don't know that overdraft fees and policies around overdraft fees change the way they do if we don't have fintech companies putting pressure on banks. So to Mike's point, it's a nuanced question. Kiah, that was a very good exploration of that first one. Why don't you give us another?
Okay. So my question of would you rather is have robust fintech industry standards or have bank regulators with direct supervision of fintech companies. And the background for this is that, we talk a lot about the regulatory parameter and that by design, bank regulators supervise chartered institutions and they don't supervise institutions that aren't chartered directly. There is licensing. You can get money transmitter licenses and from the state. So there is some state supervision, but again, a charter is a little different from a license. And Mike, I can't remember if you or if it was your colleagues at the Treasury that talked about a national money transmitter license kind of towards the end of your tenure, but that was getting a little spicy. So that's our current reality, which means that we don't have direct supervision from bank regulators. And we also, I felt like, didn't have fintech standards. And, I kind of joke about FINRA and the role that FINRA plays, which is a self-regulatory organization empowered by the SEC to regulate broker-dealers. I know as a journalist, I have, I'm not licensed as a journalist, but I certainly have pretty legible ethics codes and practices. When someone says off the record to me, that means certain things. When someone says on background, that means certain things. I have certain practices that help me professionally navigate certain choices. And so, we haven't had that. And now we kind of actually do have that. We have some groups that are thinking about this. And but they are thinking about it at a time where we've had maybe enough, regulators have found enough problems with some of these partnerships, maybe some of the fintech practices, that I'm wondering, is the standards really like a comparable trade-off to a world where we have direct supervision from bank regulators of these?
So I think the answer to this depends a little bit on if you look out, say 5 to 10 years, what do you think the ecosystem looks like?
Sure.
And personally, I think it's one where there's going to be more variety and more coexistence between banks and non-banks and fintechs and more relationships. And so if that's your starting point, then I think having a fintech standards setting, both body and regime makes a lot of sense. But I'm going to put a ton of caveats on that because what I worry about is that the standards it's kind of a way, it's more window dressing than meaningfulness. That's what I worry about. If they're meaningful standards, great. I think that's something we should have lots of discussions about. And if they're strong, we should embrace them. My concern is that in the conversations I've had on the standards, like there's a desire. Okay, good. And then once you start peeling the onion, there's just not much there. And, or there's a reluctance to have winners and losers, but that's kind of the whole point. Like if you're going to have standards, there have to be those who can clear them and those who can't. And if everyone clears them, it's just a trade group. Those aren't standards. They have to be meaningful because otherwise there's no trust. Otherwise, who is it for is the real question. Are those standards for the industry or are they for those who are being served? And so if there's and I think you've seen this play out in other settings, it is entirely possible to have standards that are kind of sit in that public-private space that are meaningful and are effective and that can be responsive. But it means not everyone gets a free pass to do whatever the heck they want. And sometimes I feel like I've seen this, like certainly in the crypto space, there were quote unquote standard setting bodies. They weren't standard setting bodies not for real. I think fintech's more serious about it, but it does mean having to draw some lines and saying like having, in a sense, some independence around who's setting that standard and what does it mean. If you guys were setting it, I would trust it.
Well, we would probably be overly punitive, maybe in some cases, because some things that happen in fintech drive us crazy. But I think you put your finger right on the button. I mean, when Kiah and I ranted, I guess, about fintech standards a while ago on the podcast, that was the substance of our critique, I think, is that, to your point, what is the purpose of this? And if the purpose is, hey, regulators, stop hassling us, that's not a good purpose, right? That is very trade association-like. If the purpose is, we want to police all of the bad actors out of our space and hold everyone to a high standard, that is a very different thing. But to your point, like, show me evidence of people not passing, right? Like, show me evidence of holding people to an insanely high standard that we can trust. Show me a incentive model that creates the likelihood for that accountability in the future. And, even show me, like, and this is kind of a small one, but like one of the things I'd like to know is, how much money are fintech companies chipping into this, right? Like Kiah mentioned, FINRA, but it's like FINRA has teeth, right? It can fine broker dealers, it can suspend their license, like it can do a bunch of stuff, it can ban people, and like that stuff matters when there's teeth and when there's financial commitments. When there's not, I do think there are examples in a narrow, tailored sense where they can make sense, right? Like a good example might be FDX for open banking, right? They're very explicitly just building a technical standard, not trying to build industry conduct standards, essentially. And so they stay out of all of that and they just focus on the technical standard. That's easier to bring everyone to the same table to do. But when it comes to having winners and losers, no one who comes to the table particularly early wants to be a loser. And quite frankly, there's kind of a negative selection of like, hey, we're starting a standards body. Okay, all the companies that got in trouble are all going to flock to the standards body. Like, wake me up when fintech company that's like sailed through this whole thing and hasn't had any problems joins. Like those are the kind of like tests that I'm watching for. Mike, you're nodding your head.
Yes. Well, I want to give maybe an example from banking. So, after long-term capital management failed. So this is like, late 90s. This was a hedge fund that failed. There have been some great books written about it. Nearly took down the financial system. Mm-hmm. And one of the lessons, if you talk to credit risk management professionals at the time, prior to that, they would say, a lot of this OTC derivatives trading with hedge funds, it's risky, it's tricky, but we're making a lot of money, so we're just going to keep on doing it. And then LTC happened. And the industry, the banking industry, the dealer bank industry got together and said, you know what, if we don't do something real, the regulators are going to come in like a ton of bricks and they're going to do it to us and we're really not going to like it. And so a group was formed called CRIMP, the Credit Risk Management Practices Group. Horrible acronym. They need better marketing. But that group was private, public, and the objective function was, what are the minimum credit risk management practices for OTC derivatives counterparty credit risk management? Mm-hmm. And they're not easy, right? You had to measure potential exposure, all these kinds of things, but it was meaningful. And because it was meaningful, the regulatory community really took to it, right? It was something that we on the regulatory side could look at and say, that's a good baseline. That's a good starting point. We're going to copy paste that as a starting point and put our own refinement on it. But that was a really meaningful thing. Now, it was driven by a crisis. As many of these things are, they're driven by crises. But often when I talk to bankers or to others, I'm like, look, on operational resilience, on other things that haven't quite happened yet, we know something eventually bad is going to happen. Instead of waiting for that bad thing to happen and reacting to it, why don't we try to get together now and try to solution it before that happens? And I think the fintech space is really ripe with kind of examples of this. And had something like that taken place before Synapse, I mean, I'm really surprised. There's a lot of revisionist history with Synapse because I hear a lot of folks saying now, oh yeah, we knew before that they were a train wreck coming. Well, if that's the case, why didn't you say anything? Why didn't you do anything about it? Like, it's not confidence inspiring to argue that now, right? And then to kind of throw up your hands and how come things aren't better? Like, well, we probably have a number of live cases now. Like, let's work on those. These are good problems to solve now when things are quiet.
I think the interesting thing about the broker dealer space is that's counterparty, and I feel like banks are kind of counterparties sometimes. Obviously, as you grow in size, you might have more financial institution counterparties, and you might care a lot about them, which is why I think we saw banks lending deposits to First Republic in order to keep it afloat. And then because they just kind of understand maybe what's happening. Maybe the power of a public signal and the vote of confidence, and that you can't buy more time in a crisis. But I actually do kind of wonder if one thing you just can't build into the fintech industry standards movement is counterparty risk, and that why should a good fintech care what a bad fintech does if they don't understand that their futures are directly tied to each other? And if they're loaning money, if they have a derivatives counterparty here, then they might care a lot more because there's just I might have to take a loss on this versus if it's not if nothing bad happens to this bad fintech, then nothing bad happens to me. And then, it's almost kind of like you have to understand that you kind of sink or swim together.
So I think this is a really critical point, Kiah. So in non-financial industries, I think in some ways it can be a little bit more zero sum. If your competitor goes down, that's great for you because you just kind of pick up all the pieces.
Oh, yeah.
Right? Finance and banking is different because it's so trust-based. Guilt by association is a very strong force. And so I think banks understand this pretty intimately because we go through these things and they're constantly being caught up in things that they don't feel any responsibility. They're not connected to. And they're like, yeah, why are people calling me? Why are depositors fleeing, et cetera? And that happens over and over and over again. So that's kind of the DNA of both bankers and regulators. New entrants into banking and finance tend to be like, oh, what's the problem until it happens. And so I think this is a good thing that you're highlighting because if you know that going in, I think your motivation to have higher standards is just going to be much stronger because you realize it's partly preservation, not just for the industry, but for yourself, actually. It's in your self-interest to have standards that those who are in your club you can look in the eye and say, you know what, I'm glad to have them in this club that's above this standard. And those who can't meet the standard, I don't want them in this club because they're going to bring me down one day. And that happens over and over and over again.
Yeah, I mean, to build on that point, I think that's exactly right. And, a question I got from actual like real non-fintech bank nerds in my life, just generally after the Synapse thing happened was, well, so is my money safe in like Chime, right? And like, that is such a hard question because on the one level, I can say to those people, because I know the folks at Chime pretty well, like they're very buttoned up. They take a really rigorous approach to managing their bank partnerships. They have a lot of compliance staff. They have a really long track record of doing this well. I would hazard a guess that their record keeping will meet the requirements for pass-through insurance if one of their underlying banks were to fail. Like just based on my personal knowledge of Chime, I could say those things. However, it's a totally valid question, right? Like after Synapse fails, it's a completely valid question because to someone who doesn't know the sort of depth of expertise sitting behind these digital brands, Chime looks like Yada. They look the same, right? Like they're not really that different from a consumer perspective. And the biggest challenge, and Mike, I actually want to ask you a question related to an idea that we were kicking around when I was in DC. I think one of the biggest challenges is, as it relates to trust, how, particularly for fintech companies, do you surface some level of visibility to consumers that they can trust this institution, right? And like the challenge today, which Jason Mikula and Kiah and I and a bunch of others have talked about is, something like pass-through insurance, which is pretty easy. There is no way to validate as a consumer that it's going to apply, right? So like you could do as much due diligence as you wanted, and we know consumers don't really do that much due diligence anyway. But even if you wanted to, you couldn't get the answer to that question, right? Like, what are you going to call up Chime's customer service line and go, hey, so can you walk me through the status of like titling for the, omnibus accounts and like how that works? Like, they're not going to know the answer to that question. And so, one of the ideas, and this is tangentially related to standards and like what the industry can do differently, is like, is there a way to surface some of that information not just to regulators, right? So like part of it is like, hey, we have these industry standards. These fintech companies are meeting these standards. We have a high bar. That's great. But like even all the way to fintech companies, like if this entity is not directly FDIC insured, I think post Synapse, people are going to be much more nervous about that. And like, is there a way to address that end customer transparency concern about trust element?
So the short answer is yes, but you have to pick there's different routes to it.
Yeah.
So I can tell you the rest will not work. What will not work is kind of self-promotion. And even if it's factually based, if a company is out there defending and explaining itself, you've lost.
Yeah.
Right? Once the question gets asked, is my money safe? You're in a dangerous position.
Yeah.
And so at that stage, you need external validators. And again, just speak for your family, your friends, when they ask you, the reason they're asking you, Alex, is because like, oh, Alex knows something.
Sure.
And he doesn't have a dog in the fight. And so what he tells me is trustworthy. Like that's the function. In some ways, regulators are the ultimate source of that, but there can be others.
Yeah.
And I think it's good this is the good kind of what if to go through. as a fintech industry or as a group to say, hey, if we're going to be providing these things, and if things were to go wrong, how do we differentiate ourselves in a way that's credible and can be trusted by folks who don't do this 24 hours a day?
Yeah.
Right.
And that's there, and what it does, it requires giving up some power.
Mm.
And
I have a friend who like banks at a fintech, and we were talking about sit-ups, as I always do at New Year's brunch. And he said that he has the fintech, and he knows his bank partner because his bank partner required him to set up an online login.
Oh, interesting.
And so he can check between his fintech account,
Yep.
savings, checking, and what the underlying bank says because he has a login to that bank.
Huh.
And I don't know like the omnibus like situation for all banks, but I was like, and I wasn't sure, like I was like, oh, so you must have a direct partnership. Remember we cared so much about direct and indirect partnerships. Yeah. And I was like, oh, that's like a really interesting way that like it's a redundant step, and like why would you go check both accounts? But I bet like it made him feel better to have that login and to have that login established prior to Synapse. And so he was able to find comfort from that, right? So he could go audit the bank, right? He could just be like, hey, is my money in the vault that you said, and it's the amount. So
I mean, these FBO account issues, I know you guys have had various discussions about them, but it's a great example. Like, how can you trust that?
Yeah.
And I think different, Alex, to your earlier point, there are bank fintech partnerships where it is very clear.
Yeah.
It's super clear between the bank and the fintech, how everything gets reconciled. And that's great. And there are other cases where it's not so clear. And I think we've seen that. And unfortunately, if there's something happens, like how do you distinguish? And this would be a great, standard setting topic number 1 or 2. Distinguish FBO accounts.
Yeah.
So that folks have certainty and confidence that, hey, if something's happening, and if they're stressed, this will get worked out. I don't have to do anything.
Yeah, I remember right after the Synapse thing happened, like immediately after. And Kiah and I were actually on a podcast with Jason Henricks like a year before it happened, roughly. And we talked
about it in the broker deposit conversation, which was kind of crazy to bring it up there. But we had mentioned the FBO accounts that like these had technically all counted as brokered.
Yeah. And I remember after the Synapse meltdown, I think the first piece I published the title was like ban FBO accounts in BaaS. And it was so interesting because on the one hand, that is like the obvious solution to a lot of these things, right? Like if there's a one-to-one account sitting at the bank, then the bank can do exactly what Kiah said. Like it creates a lot of visibility. There is no need for reconciliation. Like it's fine. But at the same time, I can't tell you guys the number of people in fintech and in banking as a service who reached out to me like I had just suggested that like, they have to live on Mars now. Like they were like, no. And it's like, I get it, right? Because the impetus for, FBO accounts is core banks are inflexible. They're expensive to have all these little individual fintech accounts with. Like I get this sort of operational reality for community banks doing it. But I think it's at least a good question to poke at and go, hey, if you want to be a bank that operates in banking as a service, maybe no FBO accounts. Like that doesn't seem like an unreasonable suggestion, even though I was flambéed for making it somewhat naively, I will say, right after the Synapse thing happened. Kiah, I'm having like so much fun doing this game. Can we keep it going? I want to sort of cut the rest of our agenda and just do more of these.
We can cut the rest of it. But Mike, this is kind of a joke. I put it at the bottom of the outline. I remember in 2022, you gave a speech about how many banks are in BaaS and you went through call reports. And I could kind of like figure out why you had this question of like, how many OCC regulated banks are in BaaS? And it's because if I had to guess, we lost a lot of visibility with the broker deposit change, which is how I used to figure out what banks were in BaaS. Did you ever figure out how many banks are in BaaS at the OCC?
I will answer the question differently. Is that at the OCC we had pretty good visibility into bank, BaaS, fintech partnerships, and kind of the spectrum of who was doing what with whom. I do think that going forward, so now I guess I'll put a different idea back out to both of you, which is, in the way we collect information as regulators, we have a long history of just reg reporting in general. the call reports, everything's pretty tabular.
Yeah.
Mm-hmm.
These BaaS relationships and these partnerships, to me, I've talked about this before. Kiah, I think I talked about this with you before. They look a lot more like supply chains.
Mm.
And in supply chains, it's not, tabular form is not a very good way to do it. Like, the better way to do it is relational.
Mm.
And so you want relational databases. So you take like knowledge graphs and things like this. Now we're in the space of like AI.
Yeah.
And I think this is something that really should be explored, because what you want at the end of the day is an efficient data gathering method where your yield of insights to what is gathered is very high. And unfortunately, one of the chief complaints from the industry, which is not crazy, it's not unreasonable, is that the yield is quite low. Like, a lot of effort gets put into reconciling internal systems with reg reports, and you generate these gigantic databases that are clunky to use. And if we're going to move into a world, again, where I think that bank, non-bank relationships are going to feature quite prominently and are going to make the world better for everyone if done right, then we're going to want like a data gathering method that can yield the insights into, you want to be able to ask the question, who has a relationship with whom for what? And if something goes wrong, what happens? And you want to be able to get confident responses quickly. And right now, that's not easy, given the kind of the current state. And I know, like, this is, I'm been really interested more recently in, like, how can kind of some of the AI methods be used to improve both supervision, regulation, and things on the supervised, on the regulated entity side. Because I think there's some real gains, because you got data-rich environments with labor-intensive activities. These are things that AI can be good at if you're careful, if you do it right. And I think it's a good space to explore.
Yeah, I can tell you that at the last little tech sprint I was at, where we were trying to fix bank fintech arrangements and solve all your problems, data and AI were very core. Like, my team was one of the few that wasn't pitching basically a solution that looked at like relational data, that leveraged AI, and even things like, generative AI is really good at unstructured data, right? And so to your point about tabular formats, we've really defaulted to just give me the data that I know can be processed using the systems that we have today. And so it relies on filling in specific columns with specific numbers. And then if someone interprets, broker deposits differently, then all the numbers get screwed up and they have to be changed. Doing something that is a little bit more data rich and doesn't require quite that level of like standardization to still extract meaning from it is pretty interesting to me. All right, we're going to do 3 more of these because these are super fun. We'll go a little faster, which is ironic because now we're wading into very like future-y areas. But
oh yeah, now we'll stop being nerdy and we'll just go fast.
Yeah. Now,
Now
as things are getting harder, we'll just skate
Okay.
by like these
I'll try
and
to keep
give
up.
very surface level answers. That's funny. All right, so the first one is I wanted to talk about stablecoins for a second. So I think it's fairly clear to everyone that stablecoins have sort of forced their way to the front of the sort of fintech and crypto agenda, and not unreasonably, right? I think that stablecoins have demonstrated finally some actual utility coming out of crypto. Ironically, that happens when you strip speculation out of crypto as a product, which I've ranted about before. But now we have this infrastructure that can be used for cross-border payments, that can be used for more programmable payments, that can be working 24/7, 365 with no breaks. So there is real utility for cross-border transactions. I actually have a podcast coming out in a few weeks with someone talking about even its use case in more of a domestic payments loyalty sort of structure, which kind of replacing prepaid cards, which is pretty interesting. So there are a lot of potential use cases for it. The thing I find fascinating, though, is a lot of the use cases for stablecoins very naturally pose a question, which is, well, if we like these things, if we like instant, global, programmable, immutable, a ledger that I can track all the data on, shouldn't we just extend this to bank deposits? Like, shouldn't this just be what the dollar becomes? Now, in the US, and Mike, you know this better than anybody, when you say anything that verges in the area of central bank digital currency, people flip out. The Federal Reserve got hammered on this when they launched FedNow, which has nothing to do with central bank digital currencies, but it was the central bank doing some new thing. And like, there's an undercurrent of privacy. I live in Montana, so like I see this every day. there's an undercurrent of privacy in this country that's very hard to get some of these ideas passed. But it does really get interesting when you start thinking, even if we do stable coins rather than a central bank digital currency, at some point, if stable coins get big enough, they will function as a way to move massive amounts of money in the economy and across banks, right? And the example that I was playing with somebody was this idea that, if you have a stablecoin based wallet that you're using to make transactions at Starbucks, let's just say, you are essentially taking money out of your checking account or savings account, and you are adding it to a stablecoin, which actually, if it's a dollar-backed stablecoin, means the dollar is just sitting in some other bank account, right? And so in some senses, it's not a net loss of a dollar not being in a bank somewhere, but questions naturally arise when you do that. Okay, we were modeling the stability of Alex Johnson's deposits at this bank. Now, how do we model the stability of deposits that are held in this massive account on behalf of Starbucks where we're issuing stablecoins? I don't think we've thought through or really tugged on that at all, but it's not too hard to see how stablecoins, even if it is kept entirely in sort of the private realm and it's not the Fed getting involved in any of this stuff, it's not hard to see the regulatory and policymaking implications of stablecoins becoming a bigger and bigger force in the economy. So, Mike, stablecoins, tokenized deposits, where are you on this topic?
All right. So I agree with you that the stablecoin use cases abroad have emerged. Those are factual. I think that there's data now to support that, especially in emerging markets, people are using US dollar stablecoins, and there's a whole variety of reasons for that. The domestic case still feels a little wishful.
Yeah.
In the sense
speculative.
I think there are a lot of people are saying it could be this, and how come people aren't using it for this, but people are just not using it for this? And I think there is kind of a law of good enough. Someone explained this to me. If things are good enough, it takes a lot to move someone off of A to B, if A is good enough. And a lot of what exists today is kind of good enough. I think if you had to extract, using your Starbucks example, Alex, what is it that's convenient, that's really good? It's to me, it's the fact that the movement doesn't have to be reconciled, right? If the benefit of kind of a wallet-based system is that once you transfer the thing, you've transferred the thing. And as a bank nerd, as bank nerds, we know when you go account to account, there's all this stuff that happens in the background that takes time and costs money and then can break. And if you can just move the thing, it's much simpler. That does not require blockchains. You can do that by simply tokenizing a deposit, quote unquote. And I think that's interesting. Now, is it enough of a benefit to get people to move off of A to B? Question mark. I don't know, actually. And we'll see. And I think it's good to pursue these things because if you can achieve those benefits and those benefits can flow through back to consumers and customers, great. Let's go do it. Let's go do it in a safe and sound way. I'm not sure the stablecoin technology is necessarily going to win that horse race, because some of the efforts I've seen by banks internally, in terms of internal ledgers and trying to move things around, the stablecoin infrastructure, the blockchain infrastructure, is pretty inefficient. It's slow, it's expensive, you get congestion, you get all these. So all the workarounds, at some point, folks are like, why are we doing all these workarounds? Let's just do it through a centralized mechanism, and it's much simpler, and then you can achieve actually even more. And so I think that will continue to play out. Now, your question about CBDCs, which I think is the analogy I have there is that it comes down to just trust. If people don't trust it, they don't trust it. It doesn't matter how many technical persuasive arguments you try to make. They just don't trust me. My dad's he used to be an anesthesiologist, and folks used to come in for pain, and they'd do all these tests. And sometimes the patient, all the tests would come back negative, but the patient would still feel pain.
Yeah.
Well, they feel pain. You can tell them they don't feel pain, but they feel pain.
Right.
The same thing with CBDCs. It's going to take a while for folks to trust that the government is in charge of something like that. And that's on us. I think that is on us to make that case and to demonstrate that and to prove that. And that will happen over time. I'm pretty confident because the direction of that will happen over time, but it does put the burden on the persuaders not to just say, how come you're so stupid and not understanding this? It's like say, is to take baby steps. It's like, look, we're doing this for this reason. You can trust this. And we're doing this for this reason. You can trust this. And then we'll get there.
That makes sense. Kiah, you and I don't spend a lot of time talking about stablecoins, but what's your sort
Almost
of,
none.
what's your like quick rant on this topic? I know. Yeah. We're trying to.
I told you I wasn't going to rant. This is going to be a really short rant.
Sure.
I have been a bank reporter since 2011, and this is the third time we're talking about crypto, stablecoin, blockchains, central bank digital currency. I cannot believe genuinely sometimes when I hear people talk about it, I'm like, where were you in 2015? I remember in 2015 saying, so wait, like, is a blockchain like a Google Doc that just a bunch of people can, like, tell me how it's not a Google Doc or like a Google Sheet.
Yeah.
And so one thing that I get that like sometimes new emerging technology kind of takes a while for it to like really like grab a hold. And I don't want to say like, oh, just because I haven't seen any meaningful use cases since in the last 10 years. And blockchain's like what, like 15, 17 now? It's old. Sorry, not blockchain, sorry, Bitcoin. And I remember reading all of these like distributed ledger blockchains that all the big banks were going to start, and they were going to have like these internal, and then I like saw all of them stop doing it. And I get that like it's just, you know, a hot thing to invest in and then not a hot thing to invest in. And so I just kind of I just have a hard time sometimes being like, what's new here? And it can't just be that more people are paying attention to it. Like I don't like hype. I'm very like sensitive to whether something is being overhyped or underhyped. When what I can tell is like very little things have changed. I also think like we're not talking enough about the peg of a stable coin to the dollar. And the reason why is because when like US dollars, we don't have to care about that at all. And other countries have had currency peg issues. And I kind of can't believe that, you know, everyone's adopting stable coins when we saw like a stable coin lose its peg like 2 years ago. And so that's all to say that, you know, sometimes I on stablecoin, crypto, blockchain, distributed ledger, CBDC, like I'm kind of in a show me state. And and the bar for me to be impressed by the utility of these things is increasing, given that this is for me the third time we're having this conversation. And like it's fine if like the conversation died down and then someone was working on it, and then when it comes around again, they're like, oh my God, isn't like this amazing? We've been investing it. And that's actually not what I've seen. And so I just remain a little unimpressed. And then, you know, separately for banks, you know, this is my own opinion, but when I think about every single week me writing an article about something that is going to help financial institutions make better, more informed, more strategic decisions using technology that will execute their strategic goals, I fail to see how these topics are going to be the answer for most of these institutions. And so that is why, you know, I think there's a lot of like interest in this, but, you know, for me to present this to institutions as more like, hey, you know, like this is the third time we're doing this again. Nothing's really changed since the last time. If it wasn't part of your strategy the second time, it might probably not be part of your strategy today. If your customers aren't asking for it, it's probably not part of your strategy. Just like, so that's my whole little rant, my mini rant about this. So
I think that's totally fair. I will say on top of that, the whole conversation about banks getting into stablecoins does confuse me a little bit, right? And obviously there's that longer term arc of like the digitization of deposits and making the sort of database technology around how we track all this better. That's a little separate from like a bank is going to issue a stablecoin. And I've seen some sort of VC tech folks get excited recently about banks embracing stablecoins. And I candidly, like, I think it actually makes much more sense for people who are pursuing use cases where it can be valuable, like Mike, to your point, cross-border or whatever. And for the most part, that's not really banks. I mean, I guess I could see stablecoins potentially disrupting like correspondent banking maybe over time. So there are some areas where there's overlap, but not a ton.
So the one like last kind of footnote to I would put on this.
The last time we'll ever talk about this topic.
Well,
go on.
Maybe just to round this out, because I have to now bring up the OCC's history on this.
Right.
On the cross-border, Kiah, to your question, I think that those banks that may have customers asking for them would be customers with cross-border connection.
Sure.
Right.
Sure.
So they're potentially, and I think that you've seen some companies that are engaged in that space that have said, hey, this is having some meaningful impacts. I think there's going to be a hearing on this tomorrow, actually, to talk about this. But Alex, to your point, if you fast forward and you talk to the stablecoin advocates, the space is going to grow enormously, and there'll be even more and more providers. That could potentially look like free banking.
Sure. Yeah, I was thinking about that.
Right?
Yeah.
Where you've got a lot of different issuers with different risk profiles. Now, but I think part of the motivation for the legislation is to say, we don't want a Wild West where all these different issuers have different risk profiles, because that's going to threaten the broader stablecoin ecosystem. Let's have some minimum standards.
Yeah.
I think the case for a bank-sponsored or bank-backed stablecoin is to say, well, these ones are now at the super gold premium level. Right. So when things eventually happen, you don't have to worry about those ones. I think that's the pitch, but that presumes kind of broader growth and adoption, and perhaps a little bit of a falling down on some of the minimum standards for non-bank stablecoins, which, who knows? I mean, the Eurodollar growth is, I think folks are looking at the growth of Eurodollars as kind of an analogy for stablecoins. And that's an interesting one, like, because Eurodollars are huge now.
Sure.
And so if that's the case, but there's a lot of what ifs embedded in that, which maybe, Kiah, we can ask these questions 2 or 3 years from now. We can take a break.
Yeah, circle back.
The fourth wave.
Yeah, once this all heats up again. No, I mean, I think that's all exactly right. And I was shocked to learn that Tether has been growing much faster than Circle, specifically because Circle lost its peg temporarily. But the broader context of that was it was keeping its money at a regulated bank and like trying to do things the right way. And by the way, all the money eventually was like restored. Right. And it's so funny to me that like a failure, but inside the regulatory perimeter more so, drove the stablecoin market towards Tether, which is like terrifyingly unknown in 9 different ways. And I think that tells you something about the current market of stablecoins. So we'll see if that changes over time.
Even the switch between Circle and Tether, like the preference, it comes back down to, do I trust this thing? Yeah. Right? Like,
but the nature of that trust is different, right? Like the question that someone who uses stablecoins, especially internationally, cares about is, how good is the peg, and like, is it stable that way? I think a lot of the things we're talking about are more, how is the accounting and management of the reserves and the regulation and supervision of that done? That's a different type of trust, which I guess is relevant to different use cases. But it is fascinating that like Tether is booming right now because the current way most folks use stablecoins has a preference for that model of governance as opposed to the Circle model, which is kind of a condemnation of the space, honestly, at this moment. All right, Kiah, you have one more, and then I have the last one. You go. Okay. You go.
Yeah. So this is going to be a little bit more bank specific, not fintech specific, but I think is a really interesting consideration of legislation that was written for a bank environment that has changed in really important ways, but also hasn't changed in really important ways. So, Mike, would you rather have updated Community Reinvestment Act or updated bank merger guidelines, and why?
So this is an easy one. Community Reinvestment Act.
Okay.
And the reason is because, look, there was a time period in American history where redlining was the policy of U.S. government and of large, of banks everywhere. And that really was just, morally wrong in retrospect, and really damaging to both the broader economy, because we're just leaving a lot of money on the table, and to specifically to communities. It was very unfair. And so with the CRA, the passage of the Community Reinvestment Act, it right-sizing that and saying, if you're a bank and you're in a social contract with the government, then you must make credit available to everybody. Like that's basically it. And that's really, really critical. And it's part of the social contract we have with banks. And I think that that's been part of the fabric of banking for some time. And it's really, really important because, as you guys know, and you guys have talked about this before on the pod, the unit economics of serving low and moderate income communities is really tough. Like, it's tough to make money in that space over a long, sustained period of time. And in some ways, CRA recognizes that and says, just because you can't make money doesn't mean that you can pull out of those markets. You have to serve them, and you have to serve them. You have to make that credit available to everyone in the communities that you serve, you banks. Now, if banking changes, so it's not just banks providing banking, but it's banks in coordination with non-banks, then that obligation intuitively should also extend. Now, it should extend in a nuanced way, not in a blunt way, but it should extend because if that's how credit is being provided, then we want to make sure everyone's included. And I think this is something that it's a great policy. And what's really interesting to me is the folks who are many people in fintech want to do this, right? This is why they got into fintech, was to democratize finance and serve niches that were being left behind by the traditional banking system. So I think there is a way for the stars to align to get that to work, but it is complicated. It's complicated, and no one likes obligations hoisted upon them. But in a way, I think it can help. I think in a way, this goes back to the standard setting discussion we had. If we can agree on what this would look like, in a way, it takes out some of that race to the bottom, competitiveness, and just say, look, everyone just has to do this, whatever this is, and that this would be serve LMI communities equally. That would be great. That's going to take a lot of very smart people and dedicated people to work on that. But I know a lot of smart, dedicated people out there who are committed to this. So, I think that's
could they rewrite the CRA rule so that it applies to non-banks? Or does it apply? I was joking beforehand. I have dedicated my career to never writing about CRA because it is a complicated law, and that, I think there was a critique that most banks passed their CRA. So it wasn't a thing that banks were actively bad at, which I think is great. Relative to how it was being measured. And I think the question was it too easy of a test to pass?
Yeah.
What is the purpose of this? How can banks, is it, I also agree that redlining is bad. Is CRA how we is this a rule that's appropriate for today's banking environment versus the wrongs it was trying to correct in the past, right? Things like that. But could you bring in non-banks? Because this might be how you get the direct supervision of banks, super regulators into the non-banks.
So the statute only applies to banks.
Right. Okay.
So and it doesn't apply to credit unions. That's a whole nother discussion.
That's a whole other topic. Yeah.
It doesn't apply to non-banks. And in terms of, Kiah, your question on modernization, part of what we were trying to do with the 2021 final rule for CRA is to modernize it because, banks look different today than they did back in 1995, which is the last time it had been overhauled. And, there were a lot of criticisms. It was too complicated, et cetera, et cetera. But we live in a different world today. And, and this is why I think this is a good topic, is that it'd be nice to make the CRA fit for purpose for today's system and how people use it, because I think everyone would benefit from that. But it is complicated, and it is going to take another try because this is all caught up in the courts now, and it's unfortunate.
Yeah, no,
I've written about. Oh, sorry.
No, go ahead.
Oh, I was going to say I've written about bank merger rules. And something that I was thinking about with bank merger rules is how the geographic component of the rule, what that has meant for, how deals are assessed. And so, there's been some studies that it's easier if two rural banks that are kind of trying to survive, and they think that, they're facing declining population. Maybe, they're facing a lot of non-bank competitors. They believe it's in their best interest to combine, but they might close the branch that's in their small town, one of two branches, right? And that would be seen as anti-competitive from just a pure geographic calculation. It's the HHI calculation, and that I was kind of struck by the idea that geography would play so prominently a role in this calculation, and that for me, it wasn't clear, does financial access through digital channels, or is that being measured? Is non-bank competition being measured or calculated? And I've seen, the Department of Justice or the board of, for the Federal Reserve Board of Governors having to, I've read their whole like approvals for deals where they have to do a secondary HHI analysis to include credit unions, right? Because you can do that if the initial one fails. And it just kind of struck me that CRA has this problem too, or this tension too, that the way people access financial services is changing, and the available financial service providers is also changing in a way that it's not clear whether regulators who are holding banks accountable for the CRA, holding banks accountable when they propose these deals, are able to understand the layout of a bank environment, of a track, of a community, the way that someone who lives in that community might experience it.
Yeah, so we could spend a whole another podcast talking about this, but let me see if I can just boil it down.
Census tracts and
So I think what you're highlighting, there is this tension where bankers, on the one hand, they sometimes they're like, just give me the rules, post the speed limit, tell me what the speed limit is,
right,
and I will just go, and I will drive under the speed limit, right? And there's a certain, as a regulator, there's a certain attraction to that because it's just very easy and clear. And parts of CRA, of the final rule in 2021, were designed exactly for that, right? We're not going to go through some big analysis. These are just very quantitative, bright line, boom, here you go, especially on the retail lending side. On the other hand, bankers sometimes are like, well, but we want to plead our case. Right? We made this investment, and this community development project is having this huge impact. You can't just go by the numbers. The numbers don't tell the story of how impactful it is. And of course, you want to take that into account as well, where it's meaningful. And so this is always the tension. And of course, banks don't do one size fits all solutions. So you put those things all together and you end up with a 1,400-page rule and then people it's too long, it's too complicated. So you're kind of, darned if you do and darned if you don't.
No, that makes sense. I mean, I've heard that that is a challenge with a lot of regulatory stuff, is just this tension between very clear rules and signs posted, very prescriptive, right, versus the alternative. And there's a risk to regulators too, right? I mean, the more prescriptive you are, the more responsibility you are taking for the rule and the fact that it makes sense and doesn't miss anything. So there is on both sides a tension there. Let's wrap up with one last one. We won't spend a ton of time on it because it's very, very future-y. But Mike, I know you've been thinking a lot about AI. You mentioned that before. A sort of very simple would you rather that I've been noodling on is, would you rather have greater financial inclusion or model explainability? And the reason that I am putting those two things in tension with each other, which I don't think historically has been totally true, right? I mean, we've had machine learning in financial services and in lending for a really long time. There are ways to extract meaning and reason codes and other things from machine learning built models. They run within a decisioning framework, all this kind of stuff. However, generative AI is just extraordinarily different than machine learning in that respect, right? It is a end-to-end solution for delivering probabilistic outcomes. And it's really good at guessing. That's the problem, is it's really good at taking in a ton of data, evaluating what it should do, and then probabilistically guessing the right outcome, right? And so we see this with the continued improvement of these foundation models. They get better and better and better and smarter and smarter and smarter. And so I don't think it's outside the realm of possibility to imagine a near future where we have a model where if we were comfortable just turning the credit decision over to the model and said, hey, here's your goal. You have to lend to as many people as possible. You have to do so fairly. And you have to do so in a way that keeps our loss rates where we need them to be, right? But go find all the alpha within those constraints and optimize for that. I think it is very possible that you could see better results on numerous of those measures, right? And that these models could actually outperform even the smartest human data scientists that are building these models today. However, I think the flip side to that, and I've heard some people argue the opposite, and I don't really buy it, is I don't think that in that scenario I described, we would have any idea how the model is doing what it's doing, right? And we could ask it to explain itself. We could do the chain of thought thing where we can look and see how it's reasoning it out. But like fundamentally, we're not really going to know how it's making that decision because it's a machine making the decision, not a human being. None of our regulations, Kiah was joking before about how every reporter has sort of their banking law that they care about. Mine is FCRA and caring about FCRA. The whole model we have is built on you need to know why you were declined if you were declined. And that is like a foundationally important principle. Would you rather have better outcomes, but sort of take a step away from that principle? Or would you rather sort of stay next to that principle, even if it means suboptimal outcomes?
So this is here today, Alex. It's already here. I've heard a number of bank CEOs give me exactly this fact pattern with numbers.
Yep.
Right. Saying they basically are running them in parallel and they could expand the credit box without taking any incremental risk.
Yep.
But they can't explain it. Right. They can't satisfy the adverse action notice in as clean a manner as they do traditionally. What do they do? And so this is live. Like it's not even, you don't even have to imagine this. This is live right now. And I think there is this, it's interesting if you kind of draw out the paths on each. So there's a part of me, I'll do my own chain of thought. There's a part of me that says, if you can expand the credit box without taking any incremental risk and basically expand inclusion, let's go do that, right? That's kind of the purpose of the financial system is to make it accessible. And if you can do that in a way that doesn't increase risk, let's go do that. The challenge with that is if you do that and the folks who get denied don't know why, and then you repeat the game. So you've expanded the credit box, but now you've moved on to the next thing, and it's also a black box. And you've moved on to the next thing, and it's also a black box. Where are you? Do people trust it? And I think this is a tough question. Someone gave the analogy of, with the self-driving cars now, statistically, a self-driving car is safer than humans, right? You have all these studies that show the statistics. Are you going to put your mom in a self-driving car to come back from the airport? Right? You're shaking your head for your listeners. And I think it's because, I understand the statistics. I'm a rational, logical person, but that's my mom. And I think, right? And that's there's this interesting, when I think back to, theories, there's the theory of justice from John Rawls, who has the veil of ignorance. If you didn't know you were going to be born as a rich person or a poor person, or as a person who gets their credit accepted or their credit denied, what's the system that's fair that you would decide on? And I think these complete black box models are tough, even though they have better outcomes. And I think it puts a lot of emphasis on how do we explain these things and how do we hold people accountable for if they can be improved or need to be improved. And that's totally worth doing. I think this is a space that really, an investment of time and energy from the industry and the regulators will really pay off, because those statistical improvements, they're there to be had. We need to improve the governance around it, the governance and the accountability. And that's a well worthwhile, because that has lots and lots of downstream benefits. The ROI on that for society is really high. But if you just do these as kind of a one-off, I think you get this, it's almost like a sugar high of yay, we increased the credit box. But if we haven't moved the ball forward on improving trust and how the thing works, I don't know how sustainable that is down the future. Because I think at some point people are like, wait a second, that's now working against me, and I don't know why.
Right. Yeah, no, I mean, just to add one quick thought, and then Kiah, I'll let you wrap us on this topic since, I know you're a lending nerd in your heart of hearts. It's the self-driving car is a perfect analogy for this, because we just as human beings have a higher tolerance for humans killing us than machines do. That's just what it is, right? And when they introduced elevators, they put elevator operators on the elevator. Didn't need an elevator operator. They didn't do anything you couldn't do, but we wouldn't trust them if there wasn't a human being pushing the button. So there is definitely that element of trust. But I also think your point about accountability is exactly right? okay, this version of the model produces great outcomes that are keeping our loss rates low, that are fair, that are expanding access. But then the next version of the model, which is just as unexplainable or even less explainable than the previous one, someone got a bad outcome. Can we tell them why? Can we hold ourselves accountable for explaining that? And it's very easy, particularly in the age of like models training new models, where there's not even humans involved in the development of the models. It's very easy to see how that could spin off out of control in a way that would be societally challenging.
Yeah, you don't want a system where everyone can point the finger at somebody else.
Right.
And there is, and I think as long as we keep that in mind, some of these have great potential to really make things a lot better.
Yeah.
But they sometimes they get driven a little too much by that. Well, I'm just going to shift the responsibility to somebody else. And again, that just comes back to trust. And I think if we just kind of anchor back to trust, like, okay, how do we ensure trust here? Then it's worth doing, but that's going to take some work. So I think that's
right.
Something to focus.
Yeah, I think it's funny because you flagged the biggest risk as like someone being denied by a model, I guess, and not being able to explain it. And for me, I'm like, how can you just say there's no credit risk or like keeps credit risk stable if you don't know why someone is a good borrower and like you can't know in your model, but you're like, oh, but the financial inclusion is awesome and we'll get acceptable rate of return. Like I was like, how would it then follow that? Like, also credit, we're not taking any more credit risk. Like, how many times have we seen someone be like, what is the worst that could happen if I bought a bunch of bonds? Like, or what is the worst that could happen if home prices are always going up? And like, I have like so little faith in a model to be able to be like, to kind of understand this like nuance of risk. And you're right, there is like, for me, there's just not any accountability, but the harm for me isn't that, again, I think FICRA is important. I think with some of these models, if you don't understand why someone is a good borrower, then you shouldn't lend to them. Or you should try to figure out why they're why your current model says they're a bad borrower, but why the AI model says there isn't. Like, you should try to close that delta. And I kind of like, to me, that's like what I'm really interested in. I think a lot about CECL, right? So like, could, if you're using this model to expand financial access, like what kind of models are you using to figure out where your reserve should be if you are expanding essentially your credit box? Because I don't think there's any risk, like there's no free risk, right? Like that you are taking a risk here when you make these loans, right?
So I should share that I have a little bit of a bias in this because of this Project Reach that we did at the OCC on credit invisible.
Yeah.
And part of the knowledge I'm bringing into this debate and conversation is that there are we know from data, there's a bunch of folks who don't have FICO scores who are creditworthy.
Yeah.
And so if you start from that point to say, look, there is a group of folks out there who we know are creditworthy. They're just not measured in a way that is easy for a bank or the capital markets to say is creditworthy. We're leaving money on the table there. So my premise in making this is that we're just basically filling that up. Like we're recognizing that value and not going beyond it. Because you're right. I have as much model skepticism as anyone because I've seen many, many models fail many, many times. But I think there's a lot of money that's left on the table right now because there's a certain amount of, I don't know if it's laziness. I think there's a certain amount of just inertia from things like FICO, which can be improved upon.
Oh, I completely, you will hear no argument from that. I guess I wasn't thinking about current cash flow modeling and what's possible with current data. I think there's like, again, I also don't think you need to like boil the ocean. If like, you can use cash flow modeling to figure out, right? But versus like going all the way to an unexplainable black box model in order to increase financial inclusion. It seems like then the goal wasn't necessarily to increase financial inclusion, but to use like the most powerful model available.
Well, and part of the issue I think with that is that it's a question of, are we using new data or are our models getting smarter, right? And like to Mike's point, the cash flow data is like, look, there's a gap in the existing data that we use to make credit decisions. This can fill that gap and let us make better decisions. But it wasn't really premised on like, we have much, much smarter models. It's just filling in the data picture. The generative AI one that's tough is, to Mike's point, this is already happening. These models can figure shit out that humans can't figure out. And so like they actually are smarter at sorting good risks from bad risks than human beings. But it comes at that cost of explainability. The other thing that I think we'll see in the soon future is, you can also really change your credit risk profile by dynamically building different types of lending products. And so the other thing, because lending products are literally just digital products, right? It's not like you're actually manufacturing a real thing. You could have AI models not only build decisioning models for like evaluating credit risk, they could actually design like custom lending products. And, if you think about the new risks and new challenges that innovation in lending like BNPL has introduced, you could magnify that by a billion with generative AI just churning out new product concepts and new ways that consumers can borrow money.
One issue on the regulatory side that we're going to have to deal with in order to make progress on this for real is, under ECOA, there's some questions about the use of identifying information for to be able to kind of test these theories out. Because, for very good reasons, generally banks are not allowed to use that kind of, race data, et cetera, because of a fear of that it's going to be discriminatory. Well, now we're in a world where what if the use of that data can actually improve and help with that explainability? That's a live question. And so that does kind of flip a little bit some of the thinking around ECOA. And this is one where I think there are people ready to use that data and to kind of engage in that research in a way that we would feel comfortable with, us on this podcast, in terms of how we're talking about it. But that's got to be done in a kind of a controlled manner and in a trustworthy manner where that doesn't somehow then become used for discriminatory or bias purposes. But that venue, that ability to have those conversations is really, really important, because I think there are folks who are ready to do it, and they just need kind of some regulatory signals that that's okay.
Mike, we have taken up a lot of your time, so we really appreciate you hopping on. This was really a pleasure, and hopefully you'll come back in the future.
Well, thanks so much for having me. I really appreciate how you guys like to nerd out and take time on these. It's very rare, which is why I thoroughly enjoyed it, and look forward to hearing more of your podcasts in the future.
Thank you for joining us.
Thanks for having me.